So I've shared my screen. I hope it's visible. So we'll start with Skipper Limited. So where company operates and what company does. So here we go. Skipper Limited will speak about the business where Skipper is present currently, financials, and what are the future plan, and also the con calls and the final tips to trade or invest in the stock, and what is the step further. So Skipper Limited, where I started tracking it is at 360, and currently it's priced at 440 with a price to earning multiple of 43. So this multiple has reduced drastically as the stock has fallen almost 40% from the top. And companies present in construction and engineering. So mainly companies business comes from pole and transformer lines tower manufacturing. So that is their basically engineering segment, which caters to 70% of the revenue. And second business they are into is polymer, and last is infra, where they take infra order here, that is EPC contracts. So the order book currently stands at 5,900, which has also increased to 6,400 crores. So for sales for F24 was around 3,200. So approximately 2x order book is maintained by company with a margin of 10%, which they are planning to increase on account of operating leverage, as well as on the basis of the polymer business, which is currently at a nascent stage and which can give a 13-14% EBITDA in future. And also the growth is also very good, which is pegged into the polymer segment. Then the company has given the guidance that for next year they can grow at a CAGR of 25% in sales, and they can multiply the EPS by 2. So they are also planning to add new capacities in this engineering segment with a capex of 60 odd crores, and promoter has sold some stock. That is the news. Okay, then we will talk about the industry where company is present and which is giving company the basically the benefit which company is driving through. So tailwind is coming from the telecom and transformer lines segment, where the infrastructure spent in transformer entire value chain itself is 9.2 trillion, which is going to happen in the cycle of 22 to 32. That is a 10-year cycle in more than 220 kV lines. So government of India is planning 1.15 lakh kilometers of lines in F22 to 27 cycle, and another 77,000 kilometers lines in next 5-year cycles. So here you can see that your RE generation capacity is going to increase from 191, which is currently there, to 596 in F32. And also the major capex is coming from PGCI, that is Power Grid, which is spending around 2,000 billion rupees to expand this RE lines. So that's there. Then you have 765 kV lines, which is going at a 13% CAGR. So that is again giving you a great benefit. So 9 lakh crore, that tailwind is sitting in front of this company, where it can gain much of traction. And also telecom sector, telecom and railway segment is where the next growth is coming from. So where they make poles basically for both of these segments, poles and towers. So here the telecom subscriber base will eventually increase from 75% penetration to 86% penetration. And if 5G rollout, currently the subscriber base is 25% of overall user will be rolled on to 5G, which is currently at 20%. So the 5G rollout is going to grow at a 7% CAGR. And also the spend, you can look at spend is increasing almost, it's twice of what is spent in last cycle. So what are the major growth drivers for this industry is rapid 5G expansion, surge in data consumption, digital transformation across segment, rise in IoT and industrial application, and increasing rural connectivity and penetration. So next is your polymer segment. So polymer segment is growing at a 2x speed by F29. So which is driven by Jal Jeevan Mission, Amrit, housing for all, Nal Se Jal. So the shift from metal to polymer pipe, CPVC pipe, is giving the traction and the infra spend across countries. The lower inventories in housing as well as the watering system is giving benefit to the this polymer segment. So now we'll talk about the projections which I have prepared based on the bear case for Skipper Limited. So for F24, their capacity for engineering capacity was around about 3 lakh metric ton per annum, and polymer is 62,000. So and current order book stands at 6,600 crores, and capacity it's running at a 85% capacity utilization. So current revenue mix is around 70% coming from engineering segment and 20 from infra, and polymer is 14%. So this is projected to be 20% in future, this polymer segment. So overall revenue for F24 was 3,300 crores approximately, which is giving you a EBITDA of 10%, which gives you 328. Interest cost stands at 147 and depreciation at 53. Profit after tax is 96. Enterprise value for the company is standing at 65,6,500 crores, because company has a lot of debt on its balance sheet, which you can understand through 2 times net to EBITDA ratio. And PP stands at 750, and current asset to turn, that is fixed asset turnover, is at 5, which I have maintained for my future projection. And debt to EBITDA, I have raised debt to 2 times of the EBITDA for future projection. And also I have funded the your fixed assets from debt itself and not the internal accrual. I'm projecting that internal accrual will be used to fund the huge working capital requirement which the company have. Around 90 days inventory is required. Inventory or working capital cycle is required in the company, and which will be sourced from internal funding. Then your price to earning multiple for F24 stands at 55, and if I give a 50 multiple on F25 basis, so it will stand at 6,800. So absolute gain will be around 30% for next year. And if I project for F29, they are already doing the capex, and the capacity will be going live in F25. I have not factored it for F25 numbers. I have only factored 25% growth for next 3 years, so which gives me an uh, earning of 10,000 crores by F29. So which gives, and I have taken EBITDA on a conservative side because they have projected 30 to 14% in polymer business, and I am thinking that operating leverage will be there in engineering business where major cost is fixed. So I'm giving 11% EBITDA there, and based on the increased debt, the interest will be double of what company is paying in F24. Depreciation will be higher because we will be doing major capexes to reach 10,000 crores of revenue to increase the capacity in future for both the key businesses. And profit after tax will be 534, which will be approximately 5x of what the company did in F24. Enterprise value, I'm projecting 15 times EBITDA, which is coming to 3x of what we are projected in F24. Then I'm giving a generous 30 P to the company to get the market cap of 16,000 crores, which results in 32% EBITDA. So here I want to highlight one or two things, that operating leverage I've considered for engineering business, and for polymer business I have taken a conservative case of 11%. So this margin can float to 12%, but I have taken a bear case where I have assumed 11% of EBITDA to flow in the P&L. And interest cost, I've assumed that the debt will be twice or thrice of what company is currently paying, and to reach 10,000 crores of revenue, company will require capex of approximately twice or thrice. So that is my projections, and with the current fall in company share prices, uh, it is giving a very good benefit to the company in terms of KGAR, that if you accumulate huge volume here, and I think the tailwind which is sitting with company also projected a 2 year 25% KGAR order pipeline of 18,000 crores, and company is also building capabilities to do 120-meter height with 1200 kV in India, and working capital days or to reduce below 90, and capex of approximately 200 will be funded through debt and internal accruals, which I have assumed that will be through long-term debts, and market leader with 15 to 20% market share in telecom towers. The company wants to be there and expecting a 15% market in T&D in India, and CVC polymer piping market share not more than 2%. So CPVC is new for company. I think the telecom towers and T&D segment is one where company has penetrated hugely. The competition is with KEC Industry, Bajaj project, and few new companies which are there. So the competition stays there, but company has healthy market share, and has you can see that 9 lakh crores will be spent, and I think the opportunity size itself is huge, and next 5 years uh, ought to belong to this kind of companies which are trading not at very huge valuation. But only concern in this company is the working capital requirement will be huge, the capex will be huge, so the ROE, ROC number will be depressed, which I have also calculated. So the ROC which I calculated is 13% on F29. So which will be depressed because of the basic reason that company is doing huge capex, and inventory will be holded for inventory or working capital cycle will be approximately 90 days. So those are the challenges to company. And I think this valuation company looks on a risk to reward basis a good company. Company has corrected deeply if you look at the correction. So company was trading at 640, and now company is trading at 414. So every day the price is slashed. So which gives you a benefit. 43 PE is, I think, generous to be offered. And if you look at my projection, I've taken it at a 55p. So that give you a major margin of safety, which you can leverage right now. So it's a time to go into this company, and I think red flags, I couldn't found many big red flags other than the inventory and the working capital cycle. They take orders from PGCIL as well as the government directly, and the private players which are into EPC businesses. So a huge opportunity, huge demand is there. Company needs to build the capability and the supply both on time, and the execution will be a big challenge because company has to work on three, four fronts: telecom, railways, your T&D segment, and your polymer segment. So three front companies merging in, so they need good set of peoples to work with them and project this growth. And I want to know that what do you think of Skipper Limited, and whether you are invested in it or want to invest in it, and you can give a brief idea of what you think of it. Thanks. Thank you very much.